All right, guys, and that's it for section 1 of the course. I hope you enjoyed it. And I want to do a quick recap here before we move on to section 2. So to start, we talked about beginner's mind in the first lecture and how critical it was to have an open mind while going through this material, suspending your beliefs and biases so you can take any of this information with a neutral stance, a non-rigid stance, and really mull on it and let it stew in your mind before tweaking your own trading process. So it's very toxic to go into a type of growth learning stage and having, being rigid to accepting new ideas. We want to have a child's mind, a beginner's mind, and take everything in with a neutral stance and really be able to chew on it. Then we went into price of action value adds, where we talked about why trading based off a chart and technicals is such a value add to investing in public markets. And it's because of that liquidity, right? We have the ability to get in and out at any time, and we want to use that to our advantage. And so we have the timing aspect of it, which tells us, when trades trigger, and to keep us out of those dead money trades that, are maybe downtrending or trending sideways or not going in our direction for months and years. We don't have to deal with, holding positions that are sitting like that. With timing, we can just try to time moves and be only in when they're moving up. And then finally, we have risk management, which we talked about defining a mechanical process to control risk, and that plays into emotional management and big bets, right? So emotional management, when we have price action to give us a mechanical way to exit trades, we don't have to worry about, every single day whether or not we should take the loss. It's outsourced to a mechanical process, and that saves our emotional capital for more important decisions. And then finally, under risk management, we had big bets, which talked about having the ability to take a large notional position on something because you have that defined risk. We don't need to plan for something to go to zero and use position sizing as a means of risk control. We can take large positions and still have stops as a way to control our risk there. And that will let us more easily outperform by being highly concentrated in the things that we think have the highest probability to move extremely far in our favor. And then finally, the emergent property, which was the property that occurs when you combine price action fundamental information, and it creates an entire new takeaway. So the example we gave was watching the stock's price action response to a positive earnings release. So if the stock tanks on a positive earnings release, well, that gives us much more information about investors' expectations and investors' sentiment and temperature to that particular stock. Right? You would never get that if you just looked at the fundamental report alone or were just looking at price action. You need both to combine, and so you can read the fundamentals within the context of price, and you can read price within the context of the fundamentals. And then finally, we finished talking about high-quality forecasts and multiple levels involved with them. So with that multidimensional forecasting, we can turn something that's very low value, like gold's going up or I'm bullish on the market, into something that's a tradable and executable campaign. Like, I think there's a 60% chance that the S&Ps are going to be 5% higher within the next 3 months, and they're not going to trade 5% lower before they are up 5%. So we get just much more specific and something that can be an actionable, tradable campaign. Now, before we end section 1, I wanted to lay out a couple of action steps for you to try to help you basically put into action what we've learned so far. So number 1, I want you to write down all your beliefs about price action and technical analysis. So really dig deep inside. What do you believe to be true about price action? And why do you believe what you believe? So if you said, hey, I believe that everything follows the Fibonacci sequence in the markets, why do you believe that? Why do you believe that to be true? And try to write that down in a journal somewhere and really dig deep and try to see, hey, what are my biases? Like, what are my beliefs? And try to get them out on paper. So when you learn the new information, you can cross-reference the new stuff with the old stuff and discard and add where appropriate. And then finally, I want you to create a multi-level forecast for your next trade idea. So the next time you're looking to get into the market, instead of just saying, getting on a hunch or saying, hey, I think XYZ stock is going higher, or, Baidu or some stock, Apple's going higher, try to get more specific. Say, hey, Apple is going to trade higher with, a 67% degree of confidence, and I expect it to go up 10%, and the maximum amount of drawback I expect on that trade is 5%. And go through those different levels we talked about in that lecture and try to create a more specific forecast. And that'll help you execute a trade with more confidence rather than just saying, I believe Apple's going to go up, picking a position size and then going for a ride. You have everything more methodically planned out. So those are the action steps for this section. I hope you enjoyed it, and we'll see you in the next section.